Hey, what's going on, guys? Corey Smith here, bringing you another pre-week market analysis through T3 Live here. So going forward from now on, I'm going to be bringing these videos out through T3 Live on their YouTube platform. I'm going to be collaborating with them now. This will be the new place to find them. So again, thank you all. I appreciate taking the time to come over and check these out. We'll be covering what happened last week. This is October 22nd, Sunday's week. I'm filming it here on Saturday the 21st to give you guys some time to prep and get ready for the week ahead. But this will be for the markets opening on October 22nd, 2017. That's Sunday. I will be covering the prior week before and this week ahead. Fundamentals, what's going on in the news all over the world with all the currency pairs we trade here, Major 7, as well as some technical setups. This video here, I'm going to cover mainly the fundamental news, each major currency pair's index, what's going on, what to look for moving forward, and then I'll also upload another video right after this showing some of the technical setups that we've been watching past weeks, and this week what I got, some ideas I've got going forward. So I'm going to go ahead and jump right into it here, guys. Starting with the performance last week. We had a pretty big week overall. The New Zealand dollar was really the story of the week, as we had a 3% move to the downside out of New Zealand dollar. Basically the second half of the week we saw this, so this was a really sharp sell-off. We saw a Japanese yen close second behind with a 1.5% decline, which is still a decent move for a week as far as the currency markets go. Then the Canadian dollar is going to be the third weakest with 1.2%. The dollar led the charge, followed by the euro and the pound, close seconds. This is all weighed against the US dollar. That's why you can see everything's negative versus the dollar. That's just because the US dollar was the top performer on the week, and everything is weighed against it to come up with this performance. So that's why it looks like this. But the euro and the pound were the second top performers of the week, with the dollar being the number one performer. Switching it over to the index charts here. As you can see, this is the Dixie, the US dollar index. Basically shows the overall performance of the US dollar versus a basket of the other currencies. And as you saw all this year, beginning really back in January, February, we saw a downtrend begin, and price was just moving perfectly downward, coming up and touching the SMAs. The spacing was perfect. We had the 20 below the 50. Price would come up and touch it and moving down in perfect levels until we hit the bottom here in September, and price kind of moved higher off this bottom. We set could be a new higher high violating this here, but really no clear strong trend reversal has been set yet until we break this 94 level around, we'll say here. As you can see, this blue weekly level and this red daily trend line we've got here. We can see the 20s now crossed above the 50 SMA, and what I've been preaching for a few weeks here now is the formation of this beautiful inverse head and shoulders that we have here. Nice technical setup for a reversal, and we've got the right shoulder has now formed. So I've been talking about this for a few weeks now. What we were looking for this week is if price can finally break this trend line and resistance zone here, which is also the neckline of this head and shoulders. And if it does, we should have some pretty good room to the upside, back up to around the 96 range up here. We'll just have to wait and see, because price could easily bounce off this and reverse to continue the downtrend again. But all eyes are looking bullish to me now as we come back up to test this level again. This week, as you can see, the dollar started down here on the 50 SMA-ish and came up, rallied down a little, came up with the rally, bounced down a little bit, corrected, and then Friday ended up pushing higher again. Switches us over to the euro. Euro was pretty choppy on the week, ending slightly lower but basically flat. Was one of the top performers on the week, but really not too much moves. As you can see here on this daily chart, this is essentially going to be an exactly inverse related looking chart from the dollar. The euro and the dollar make up about 60% of the Forex transactions, so they're going to really tell the same story on both charts, but it's still good to have insight as to where both are headed and where they're going. As you can see, that inverse head and shoulders is exactly the same here with this, sorry about that, with this regular head and shoulders we got going on here. So the euro is pretty much performing the exact opposite of the dollar. Let me bring this tool out, might be a little easier here. But we've got the exact opposite thing happening with a neckline here. We got a left shoulder, we got a head, got a right shoulder forming now, and what we're looking for is a break of this neckline. If we see a break of this neckline at around 113, I'm definitely going to be looking to be shorting the euro. As we saw on the dollar chart, it's in basically the exact same spot. The moving averages have now crossed. We hit the 50 SMA on this strong resistance and have slightly bounced now. So we'll be watching this strong 113 zone as well, see if we're going to bounce higher and go back to this uptrend we've seen all year from the euro, or if it's going to reverse and we're going to see now a downtrend form here. Taking us over to the Japanese yen. As I said last week, we're expecting it to come back up with the touch to this resistance that it just broke right on the 200 SMA you see in here, and did pretty much just that. Came up, hit the SMA, and then sold off. We got a risk-on environment going on here with equities plowing through new highs all week. So that typically sees some money leaving the Japanese yen, and we're definitely seeing that here with a sell-off, especially Friday's huge blow off the stock market. You can see we had a break and close of this strong support here. And this is going to be closing now below 3-month low. It hasn't been this low since July, so pretty significant low that it's now made. And we got the moving averages crossing. The 20s now crossed below the 200. The 50s now sloping downward, so we're definitely now in a downtrend with the yen. So we're going to keep an eye on this for shorts with the yen if the risk on continues this week. But we could very well see a little fake false breakout here if we see a correction in the stocks this week and money starts to return to the yen. But we, as traders, we like to keep an eye on both ends, not anchor to any one idea. So we're going to keep everything open, but the overall bias is definitely going to start the week bearish with the yen here. Taking us to the British pound. Very volatile currency lately, as we've had Brexit looming, and then we've had Bank of England that wants to hike rates but doesn't want to until a negotiation's been made between the EU and the UK with Brexit. So it's really been a pretty volatile pair. Ended lower on the week, but it's still trading above the 50 SMA. So we're still kind of in this uptrend. We had this sharp sell-off, rallied back up. It's been a really kind of sloppy pair, not too clear of a trend. The 20 sloping downwards now, but it's really been choppy. It's as you can see, although it's been generally moving in an uptrend, it's been making very choppy moves in it. No clear direction one way or another because this pair has just been so volatile. Essentially right now I'm going to need it to break out of this range it's in, really between 129 and 128 before I have any real bias. If it broke below 128, I would definitely be looking to sell it back down to 127-ish, as there's some room to go. But all in all, no real clear direction on the pound, so I'm not really going to have any strong bias to start the week here. The CAD, on the other hand, we saw a strong rally here, strong bullish move with the Bank of Canada hiking rates here back in September. And then we peaked out here at 81.50 and have sold off since, as the data coming out of Canada now has kind of reversed a little bit, and it's kind of making it seem a little bit making the Bank of Canada a little bit double think this rate hiking. Maybe they're going to a little slow down a little bit with it, but the 20s now crossed below the 50. We have price broke this strong support, which is also a nice little uptrend line here. So definitely some more bearish, some more bearish overlook here out of the CAD. As you can see, it's been selling off pretty drastically over the past few weeks here. It's coming back down to this strong weekly level, so we'll have to see what it does here. It was really ugly choppy in this range, but now it broke out, so we're having a little more bearish direction. But again, I'm going to have to wait and see. I definitely would say I'm entering the week more bearish, but going to have to still wait and see. I'd like it to break below this 78 level here before I start really looking for shorts on the CAD. And the Swiss franc, if you guys have been following these videos, I really didn't like this pair for a while, but a couple weeks ago we broke out of this long range that we had up here, and it came down to test this support zone here, 96.50, and then it came back up, retested the broken support, turned resistance now, and as I said, it would fall back to retest these lows. It did, and then ended this week breaking below this support. Again, the Swiss franc works hand in hand with the Japanese yen as a safe haven currency. So when we see risk on environment like we've been seeing the past long time now, but especially the past week or two, you can see a lot of money start leaving places like the Swiss franc and the Japanese yen. People wanting to start putting a little more riskier bets out there in places like the stock markets. So you can see a little more sell-off, less demand for the Swiss franc. So you can see it broke this strong support here. So I'm now switching to a bearish sentiment even more so with the franc. going into the week, and again, that depends on if the stock market stays rallying and we stay seeing this risk on environment. That could change in the drop of a hat, just like anything with these markets, but we like going into these weeks with at least an idea. It can change easily, but we want to at least have an idea and a direction to guide us to begin with. And we also broke the 200 SMA this week, which is a pretty significant level to break. So we'll see how we open into this week. The Australian dollar, New Zealand dollar, and really the CAD have been really a funky story lately, as these are, as I said, with the Swiss franc and the Japanese yen, and really the euro, safe haven currencies of late. The Australian dollar, New Zealand dollar, and CAD, they're going to be our growth currencies. So during times of risk on, when the money's going to riskier assets like stock markets and such, when the economy's looking good and there's a lot of good sentiment out in the markets, money tends to go to the higher growth currencies like the Australian dollar, New Zealand dollar, Canadian dollar. They're commodity-based environment. They are not as developed as nations, so a little bit more riskier and more higher growth potential investments. They're higher yielding currencies with the interest rates with the New Zealand dollar, Australian dollar. So typically we see these currencies inflate and go up in value when there's rallies in stock markets. But lately that has not been the story, and this really sets a very bearish tone to me for both of these economies. Although they're a little bit more lagging in the recovery since the financial crisis, they're still slowly recovering and further behind than the rest of the world seems to be. This is still telling me, as far as their currency and rate hiking goes, we could still see some more bearishness out of them for the near to medium term future as we move forward here. But the Aussie was in an uptrend, as you saw here, and then price violated this uptrend, set a drastic lower low, touched this weekly zone here, bounced higher, and this could be an ABC Elliott wave correction. We have the A move down, the B move here. Now we could be seeing a C down to, let's say, 76.50-ish down here. So could expect this to at least come down and retest the lows down here around 77.50. So I'm definitely bearish now on the Aussie with the 20 crossing another 50. We set this new lower high, so we'll see if we come back down and retest the lower low and possibly even break through it. And finally, it takes us over to the New Zealand dollar chart. So as you can see, we were in this big head and shoulders, and then it was choppy, didn't really form a right shoulder or break out of it, and then it did finally break out of it, and as we said, it came back up to the 72 level, retested it, and I was calling last week for a sell-off from this retest, but never would have guessed it to be this hard of a sell-off, this 3% sell-off that we saw this week. But with the political news that we got this week, we can see Thursday and Friday we got a huge sell-off. And technically lined up, the chart lined up perfectly, and fundamentals were the driving force that plowed it down there. So everything perfectly lined up here. You can see this 72 is a very strong level. Broke the floor of the support, came back up, retested it. You can see this indecision up here. The sellers kept coming in every time buyers tried to push it higher, and then boom, we had a sell-off. So really strong movement here from the New Zealand dollar to the downside. I'm seeing nothing but bearish signs as we're setting lower lows and lower highs for the past 6 months here. So I'll be looking for a rally for sure this week out of the New Zealand dollar, but all in all, I'm looking short for sure moving forward. All right, so that covers the currencies here for us as far as the performers last week. So now we'll move ahead and cover the news events. So beginning with last week, we had a pretty busy week here with planned and unplanned events. Beginning with Sunday last week, October 15th, we had the Bank of Japan, Governor Kuroda, and the Federal Open Market Committee with Janet Yellen both spoke at the Global Economy panel discussion. Started with Kuroda speaking, and the only real takeaway from that was that the Bank of Japan will continue their monetary easing in an effort to boost inflation to its 2% target, which Kuroda feels they're still a long way off. What he means by monetary easing, it's pretty much an unconventional act from the central banks of monetary policy to increase the money supply in an attempt to stimulate the economy by keeping interest rates low. They do this by purchasing government-backed and other securities to dump money supply into the markets, and like I said, it keeps the interest rates low to encourage lending and borrowing and kind of try to stimulate the economy to get inflation going and growth going back up. Yellen was really optimistic about the looks of the U.S. economy in the future and rate hikes as well. She's went off about how the hurricanes, temporarily are going to dampen the data as we're seeing, but she thinks they're going to rebound by the end of the year and suggested that interest rate hiking will continue as planned. Economists are anticipating another rate hike in December, as well as the forecast is for 3 more in 2018. So we'll see how this changes with the data coming out in the future, but Yellen kind of gave an optimistic start to the week there Sunday night. Following that, we had Chinese CPI beat expectations, PPI beat expectations, CPI was as expected. So another good start to the week with risk-on numbers with one of the biggest economies in the world out of China. This took us into Monday. Equities started opening higher in the record territory and ended up closing just off the highs. New Zealand CPI was the first real data we got Monday. Again, CPI is the consumer price index. It's used by the Reserve Bank of New Zealand to gauge the level of inflation. Shows the change in the price of goods and services purchased by consumers. The inflation numbers are really one of the main things we're following right now in the global economy, especially in foreign currencies, because now that we're back moving into a rate hike cycle, central banks are really looking for inflation to start picking up again. So these numbers are closely watched. As you can see here, we beat expectations 0.5% as opposed to 0.4%, which is really good. However, the New Zealand dollar did not take it very good. This again was another factor why I was kind of bearish in the New Zealand dollar, as good news not making it perform better is always a bearish sign. Then we had the Australian dollar's RBA meeting minutes. This is just the detailed report of the prior meeting that the RBA had with their rate statement. It's released 2 weeks after the meeting. They kept the cash rate unchanged at 1.5%, but the main takeaway from this meeting was basically that they acknowledged the world has entered a rate hike cycle, but Australia is not yet ready to begin hiking and entering that hike cycle. The timing of the hikes really are dependent on their own domestic economic conditions, and they're still recovering from the financial crisis and well behind the rest of the world, so they're going to play it by ear with the data coming out. Kind of known, but shows where they're at and where their central bank's looking moving forward. Taking us to Tuesday, we had out of the UK with the pound, the CPI numbers. This is the leading indicator that they use out of the UK with the Bank of England to gauge the inflation. And their target is based on CPI, so it's very closely watched. The report came out as expected, right at their 3% anticipation. And the pound initially sold off. PPI numbers also missed, which is a leading indicator for inflation, so this could be why. But following that, we had CPI year over year out of Europe, which was as expected at 1.5%. But although this is good and this is steady, this is still well behind their goal of 2%. So nothing really to call home about. Nothing really too encouraging for the Bank of England or anything, especially with everything going on over in Europe. As the expectations are being hit, but we're still a long ways off that target. And then on Tuesday, we also had in Catalan, I'll cover that again a little further here in detail, but in Spain with the political unrest we have going on over there, basically Madrid set a deadline on Thursday for the Catalonian government to declare independence or not. And so that was going on Tuesday. Then we had the Bank of England, Carney spoke in front of the Treasury Select Committee, but nothing really came out of that. No real moves in the market or anything. The only thing he really mentioned was that they expect the inflation to peak above 3% in the near future. So, again, nothing really too crazy going on there. Stock markets on Tuesday moved higher. The Dow finally broke 23,000 for the first time, then eased back off the highs a little bit, and the S&P slightly up. NASDAQ was a little bit lower. Another thing going on Tuesday, not on here, was NAFTA talks, complicated further between Mexico, the U.S., and Canada, which is something really to watch for the peso, the Canadian dollar, and the U.S. dollar. But Canada and Mexico really have just refused to accept the U.S.'s stance on it, and they've extended the negotiations from December of this year to March now of 18. So this is something to keep an eye on. Another thing going on which led to some strength in the U.S. dollar I want to cover real quick is the new chairman for the Federal Reserve Board, the FOMC. Like I was saying, Janet Yellen right now is the head, but right now Trump's in the middle of deciding a new one in a fairly short period of time before he goes to Asia in the beginning of November. So really next week we should see an answer. He's got 5 potential candidates he's been interviewing with. Apparently he's done the interviews. The first option is to keep Janet Yellen, who's the current serving head of the board. she would be, the market's favorite option as far as stability and the least volatile U.S. dollar we'd see. Then we have the one of the federal governors, Jerome Powell. He's probably the second most stable pick we could see, as he has a very close insight as Janet Yellen, and would most likely follow in her footsteps pretty closely. The third one would be the former Fed governor, Kevin Warsh. He was the governor under Ben Bernanke during the 2008 financial crisis. He's slightly more hawkish than Yellen and Powell, so he could cause some stir and some bullish dollar if he came in. Fourth, he's probably the most volatile one that we would see if he was elected, but the Stanford University economist John Taylor, he's known for the Taylor rule. He's seen to be probably the most hawkish of the options, most likely to hike rates faster. And he is not really a favorite, doesn't look like at this point, but definitely would cause the most market stir. So keep an eye on the headlines for if there's any changes in who these favorites are. The fifth is going to be the top economic advisor to Trump right now, Gary Cohn. He's the current National Economic Council director. Really the least likely to get the position, as he's really Trump's right-hand guy for the economy, so I don't think he would give that up to send him over to serve the chair. So we'll look to see here. It's looking more like Jerome Powell is going to be it. That would be different than Yellen, as Trump campaigned on getting her out of there. There's a lot of conservatives against Yellen, so he might have to, back his supporters a little bit by getting her out of there, but doesn't want to disrupt the markets too bad, and he likes low inflation. Trump, he's a real estate guy and a pro-business guy, and he likes the low inflation environment, so Jerome Powell would keep that low interest environment. So we'll see what he does here, but keep an eye on this in the headlines. So that was pretty much all the uncovered news here that's been going on. Takes us into Wednesday night. Wednesday we had Draghi speak. Slight strength in the euro overnight, but nothing really special. Dovish price action afterwards, but nothing really crazy going on there. We had further Brexit talks, and the EU leaders basically need answers from the UK for the Brexit deal to be made. Their financial commitments put forth so far by the UK, they're saying, are not sufficient enough. They're lowballing too much on their financial obligations. So really got to keep a close eye on these Brexit negotiations. The further they get delayed and complicated, the more we're going to see the pound sell off. The closer we get to negotiating a Brexit deal, the more strength we'll see return to the pound, because then the Bank of England will get to hike the rates like they want to do. This took us right into the average earnings out of the pound, Great Britain, out of the UK. This is going to show the increase in wages. And this is something, again, going on across the world, that we've been seeing good employment numbers around the world, but we're not seeing wages pick up. So this is something we really want to keep an eye on as we start seeing these numbers pick up. This is a great sign, and we saw that exactly out of the pound. It beat expectations. Should have been positive, but it really just chopped around. And again, the Bank of England says the time's running out for Brexit negotiations. They want to hike. The Bank of England really wants to hike rates. But Brexit negotiations, they really need to happen before they do that. There's just too much uncertainty with that. They really want to get that done with so that they have a clearer path moving forward. But it's something really for us to keep an eye on. And then Wednesday, again, stocks in record highs all day. So really, this risk-on environment's just been topping the headlines. It's just been absolutely blowing off the tops here with the stocks. And then one of the biggest events of the week was out of Australia, their employment change and unemployment rate. This is going to be equivalent to the NFP out of the US. So it shows the amount of jobs created for the prior month and what their employment rate is at. And as you can see here, it beat expectations on both numbers. And as we should have seen a really strong Australian dollar off that, again, we're still not seeing this bullish price action following these stronger economic reports. So it's really putting a cloud over these growth currencies, the Australia and the New Zealand, for me. So this is something to keep an eye on moving forward. But economic data is picking up a little bit here, and that's a great employment numbers report coming out of Australia. So they're definitely starting to see a little bit more recovery here. And then China's GDP numbers hit expectations. No surprise or real market volatility around it. But the industrial production did beat slightly. Again, no real trading events out of this necessarily. We like looking for trades in New Zealand dollar and Australian dollar around these events, as their economies are really closely related, and China has a big part to do with the risk on, risk off theme in the currency markets. And as I said, New Zealand and Australian really perform in the risk on environment. So something we really keep an eye on. But again, this is just another factor leading to the stock market rise and the risk on. So this just continued to fuel that fire, as we saw again with Thursday's stock market and Friday's stock markets continuing higher. We had Thursday night, early morning, out of the Great Britain pound, we had the retail sales month over month report missed expectations. This was a pretty bad report. We had about a 60 pip move lower and whipsawed back afterwards. Pound was a weaker performer on the day after all, but again, we want to see, if we start seeing bad numbers out of pound with Brexit looming, we're going to see a strong sell-off. It's inevitable, but nothing yet consistent enough, because we're still seeing good numbers out of the UK region, so nothing worried about yet. This is just typical mixed numbers, cyclical type stuff, so not a big deal. But if we start seeing consistency in missed numbers out of the pound, something to look for. And if we continue to see strong numbers, then that's again something to watch. So we like keeping an eye on all this stuff to make sure we know what's going on. But the big event really that happened Thursday, late night Wednesday, early Thursday morning, was the New Zealand dollar sell-off that caught so many people off guard. That was my trade of the week. I didn't necessarily expect that to happen, but a technical setup just perfectly lined up with the New Zealand dollar short. But essentially, the New Zealand election happened on September 23rd, and there was no majority determined in their parliament, so coalitions needed to be formed. And the Conservative Nationalist Party won the most with 56 seats, while the Liberal Labour Party won 54 seats, and the New Zealand First Party won 9 seats. 61 seats is needed to hold a majority, so clearly it's a 120-seat parliament, so clearly none of them had the majority, which is why there was no majority declared on the election day, so they had to form a coalition. And the Conservative Nationalist Party has had the majority for the past 9 years, with Prime Minister Bill English in charge. And basically what happened Thursday night, or Wednesday night, Thursday morning, was a coalition was finally formed. The New Zealand First Party formed the coalition. They had to choose between the Labour or the National Party, and it was thought that the National Party was going to be, but they actually formed the coalition with the Liberal Labour Party, making Jacinda Ardern, however you pronounce her name, the next Prime Minister of New Zealand. And this was an upset, and obviously the last 9 years the governing party no longer has control, and now the majority falls in the hands of the Labour Party. And anything that catches the markets off surprise like this, and anything unexpected like this, always causes the most volatility. So really that major sell-off that we saw was mostly from that volatility. The reason I'm expecting a rally this week is I'm expecting the smoke to clear a little bit, people to realize it's not the end of the world in New Zealand. The Prime Minister's a different party, not a big deal. Yes, she's got conflicting views, but they have a majority. They'll be able to get things done. She doesn't have that crazy of views as opposed to Bill English. So that was the real story, though. That's why so many people couldn't understand what this sell-off with the New Zealand dollar was, but that's what it was. Keep an eye on the political events going on around the world with these elections. This has been a really, really, really crazy year as far as geopolitical events, so it's been a little out of the ordinary, but definitely worth keeping an eye on all this stuff to try to stay away from events like this, or if you like trading them, make money off of them. But on Thursday, again, U.S. equities opened lower than the markets. Around the world were open lower as well, with a risk-off theme slightly, because there was poor earnings out of Europe, and Apple kind of dragged down the tech sector, but they rallied at the end of the day and ended flat or slightly higher on the end of the day. And then again on Thursday, as I said, the Spanish government gave Catalonia until Thursday to declare their independence or not. Basically, Spanish Prime Minister Rajoy told a special cabinet is to hold a special cabinet meeting on Saturday, which is today, which he would trigger Article 55 of the country's constitution. It's never been triggered before, and there's pretty much a decent amount of it that's unknown, but basically what it would result in is a suspension of Catalonia's government's rule over Catalonia. They're a part of Spain, but they have their own police force, government, everything running their own region. And essentially what Spain's government is saying is they're going to remove temporarily that ruling body. Madrid's going to have direct rule over Catalonia. They're going to have a snap election in which they're going to re-elect Catalonian officials, take out all the opposition referendum leading officials in there now, and re-vote in all new people. And essentially they're the referendum that's been going on in Spain. Catalonia has been fighting for their independence from Spain for a while now. They make up like a fifth of the economy in Spain, so they're a huge part, and they want to be on their own. They've got their own police force and economy and government, as I said, so they just want to be their own governing body. So they called forth a referendum to vote on it, but the Spanish government deemed it illegal, so they came to vote anyways on October 1st, I believe it was, and Spain and Madrid sent out all their police forces to try to stop the voting from happening. There was a huge clash between Catalonians and the police force, hundreds injured, but a vote still happened, and 90% of the voters voted for their independence. However, there was only a 40% of voter turnout. So it's been a huge legal consumption over there, and really it's resulted in what's going to be a wipeout of the government of Catalonia, and all new ones elected in a snap election in the next 6 months. Madrid announced today they're taking over. The Spanish Senate has to vote on it next month, but the Conservative Prime Minister's party has majority there, so they'll vote it in no problem. And yeah, so keep an eye on this, though. If this turns violent or anything, as I'm not expecting it to, but if it does, this could cause more unrest in Europe, more nationalist movement, more anti-Eurozone movement that could really cripple the euro, and it could fuel this head and shoulders we saw on the chart. That could fuel a little reversal here. So we'll have to wait and see how this progresses, but definitely keep an eye on the headlines for Spain and the Catalonian referendum. Alrighty, that covers Thursday, taking us into Friday. Overnight Friday, Angela Merkel out of Germany basically reached out a hand to Theresa May in the whole Brexit ordeal, and says she wants to have clear arrangements, not some kind of unpredictable solution, and we are working hard to achieve that. She also said there's zero indication of the UK leaving without a deal, and the ball is not just in the UK's courts, but she believes it's now in the European Union's courts as well. So she basically just reached out a lending hand to Theresa May and said, look, everybody now needs to step up and start working together. The UK, we can't just leave them on their own. It's been talked about that the UK could just walk away from the deal at any time, which would be catastrophic for everyone involved, really, but Angela Merkel is really getting involved to try to reach out a hand and make things better. So I think this will help. But again, we have now stock markets on Friday ripped to record highs. Just total blow off top. I'm going to switch over to the S&P 500 chart in a second here. But basically what we're seeing out of the chart here is we've been in a bull market for some 9-10 years now, as you can see, and it's been way longer than all this, but as you can see, for the past year or so we've really been just ripping higher, and for the past few weeks and months we haven't even been looking back, haven't even been coming near the 20 SMA, and just been ripping higher. And a lot of times the ends of bull markets end with a phase of euphoria, which is basically just the markets are getting higher, everyone's talking about it, everyone wants to join in, everyone who's everybody, people that don't know anything about stocks see and hear about it day and night on the news, so they decide eventually, I'm missing out on all this money, I need to join the party and start getting in on this money. And everybody jumps in and joins the markets, and there's this last euphoric plow higher, and then there's nobody left to buy. And what happens? A sharp correction, sell-off happens, and we get a reversal. And I'm not saying the markets are going to reverse, because the data supporting a bull market is still totally there and coming more and more daily, but we definitely need a correction. And I'm not trying to call market top or saying anything, but we're certainly in need of a 10%, 15% correction or so. So I'm certainly going to be watching for a correction sometime, and that's when a great time to play a strong yen, strong franc, strong euro, if we get a correction there. So we'll definitely have to wait for this and see, but I'm really starting to see this euphoric blow off top start to happen, so something we'll be keeping an eye on here moving forward as we take this to the next week here going forward. Taking us into next week, we have starting on Sunday, tomorrow the 22nd, absolutely nothing going on. Sundays are typically a horrible trading day. You won't find me trading many Sundays. Very rarely, if there's an event or something going on out of Asian markets or something, you'll see I'll look for a setup. But typically Sundays, even Mondays, I won't really look for anything. As you see here, we start the week really slow. This is going to be a very heavily weighted second half of the week, as we have two central bank meetings. But Sunday, Monday, start off with nothing. Then Tuesday we have the European PMI numbers. France and Germany, two of the biggest economies in Europe, giving their purchasing managers index. This is going to be a survey of the top purchasing managers in the manufacturing sector in Europe. Basically, it gets a gauge of how they feel about the business conditions and the climate, and it's a leading indicator of the economic health in the European manufacturing sector. So all these numbers coming out usually have an impact on the euro, so we'll keep an eye on that for any trades setting up Tuesday early morning. Takes us right into the Australian dollars CPI, Consumer Price Index. Again, I've gone over, this is the inflation numbers, which we know is a hugely watched number right now, as we are really in need of a inflation pickup around the world. Presents some good trading opportunities. Australian dollar releases their CPI numbers a little later than the rest of the world, but still a good trading event, and we're looking for increased inflation to start picking up over in Australia. Wednesday, we've got the British pound's preliminary GDP. This is the gross domestic product. It's the main gauge of the economy's health used really internationally. And the preliminary is going to be the first reading of 3 reports and typically is the most volatile. So this could be a good trading opportunity as well for the pound. Then later on that morning, we have the core durable goods out of the U.S. This is going to be a leading indicator for production in the manufacturing sector, and it shows the change in new orders placed for durable goods in manufacturing, excluding transportation, because that's a very, very skewed and volatile reading. But then we have the next Bank of Canada monetary policy report. This is going to be their rate statement, similar to the exact same things as the FOMC, the central bank out of Canada. They meet every quarter. Last time they met in July, they hiked rates up from 0.50 to 0.75% for the first time in 7 years, and the CAD, as we showed on the chart, shot up like a rocket, topped out, and has sold off since, as the numbers out of Canada have not been too great. And with this meeting, they're not likely to hike rates pretty much at all, but we're looking for the wording of the future outlook out of Bank of Canada and what they're going to be looking for moving forward and when they're going to be able to hike again. And basically the overall dovish or hawkish tone is what we'll be looking for out of the Bank of Canada. So we'll keep an eye on that here moving forward. They hold a press conference at 11:15 a.m. Eastern Time afterwards to basically just cover what they went over in the meeting and what their statement showed. Don't really have anything else the rest of the day there until Thursday. We have the minimum bid rate. This is going to be the rate statement out of the Bank of the European Central Bank. Their interest rate is still at 0%, where it's likely to remain until inflation starts picking up and everything, until they start seeing a need to start hiking again. The ECB meets 8 times per year, just like the FOMC, and really all eyes are going to be on Draghi. As we saw last meeting, they didn't really give any clear direction for their stimulus program that they have going on right now with their monetary easing. So we'll be keeping a close eye on what they're going to be doing as far as when they're going to start unwinding their asset purchasing program. So this is something we're really going to keep a close eye on moving forward here. And as Draghi could jawbone the euro lower, since it's been kicking so much higher all year, we're going to really have to just wait and see what he does. And again, I'm really looking forward to both of these Bank of Canada and European Central Bank press conferences, as they usually present some good trading opportunities and at least give us some direction for some strong movements for follow through after the events and the rest of the week. So this is something I'll be looking to follow pretty closely. And as far as this quantitative easing, the monetary easing that we're going to be looking for him to talk about, basically what this is the central bank, like I talked about with Bank of Japan, it's the central bank purchases securities, government bonds, and other such things to increase the money supply, keep interest rates low, and by purchasing all these securities, they're dumping money into the financial markets, giving financial institutions more capital, which is encouraging them to lend at lower rates, encouraging businesses and all other people to borrow money. And we're really looking for when they're going to start pulling back on this stimulus that they're doing. And last time they met, Draghi said that at a minimum December 2017 of this year, they're going to be doing it through. So we're looking to see how long they're going to continue doing this for, or if they're looking to stop at any time in the near future and things of this sort. So this is going to be another great thing to look for as far as his wording in the speech, and see what their outlook is really on the overall economy out of the Eurozone. Taking us into Friday, we have the advanced GDP out of the U.S. This is going to be the quarterly GDP reading, released 30 days after the quarter ends. Really big data, as the advanced GDP is similar to the preliminary out of the pound, it's going to be the first GDP report of the quarter, and then they revise it, and then they come out with the final one. And this is going to be the most volatile, as it's the first report released. And we had a funky quarter with the hurricanes and all, but this will be definitely a good report to watch for the U.S. dollar. See how we get a reaction, see if we can get some direction for the coming weeks, and see how the economy is looking here moving forward as this GDP rating. But alright guys, that pretty much wraps up this next week and last week. Sorry it took so long here. I know we had a lot of data to cover. Try to keep these videos typically shorter than this, but we just had a lot going on this week and wanted to cover as much as I could for you guys. I'm going to do another quick video after this covering some technical charts with the majors as well as some others I got my eye on coming forward here. So make sure you check that out, especially if you like technical analysis. This news stuff is really good to keep an eye on. Technical analysis really guides the price on the charts, but the fundamentals in these news is what is going to be sending price. This is going to be the driving force behind it. The technicals is really just going to be the guider that's guiding it in the right direction. So keep an eye on this stuff. Stay tuned with these videos. You can skip around if you want to get the important parts that you feel of your trading plan that's necessary, or however you want to do it. But really, I appreciate you guys either way taking the time to tune into these. Make sure you subscribe to T3's page here at the bottom. Stay tuned. Follow this playlist with the Core FX market analysis, and I'll be putting these videos out every week for you guys. Again, I really appreciate it. Thank you all for the support, taking the time to watch these, and I'll catch y'all next week.